Hey traders, for today's trade we're looking at a covered call strategy on Dow Jones stock AT&T. This was recently named a top value stock by Goldman Sachs, and the stock is one of the top yielding stocks in the Dow at this time and has a pretty nice uptrend showing improved relative strength. So looking at AT&T on MarketSmith, shares have been on a solid run since mid-October and are currently trading well above support at their 50-day and 200-day moving averages. While the run has occurred in mild volume, shares are trading very close to a 1962 cup with handle buy point. But investors should beware that this blue chip has earnings right around the corner. You can ignore the wild action of today since a halt on a number of NYSE stocks distorted their charts. AT&T is set to report earnings before the opening bell on Wednesday, and analysts will be focusing on the firm's 2023 free cash flow outlook. The key advantage in this case of earnings being announced this week is that option premiums are inflated compared to normal. That can be advantageous for investors looking to sell covered calls. Early in December, implied volatility for AT&T was around 18%, but is currently sitting at 27%, despite the general market volatility dropping. AT&T shows a healthy dividend yield of 5.8% at this time as well. Investors searching for yield can further enhance it on AT&T by using an option strategy known as covered calls. So as a quick review, a covered call is a simple strategy designed to collect income while also defining a predetermined exit price at which you'd sell the underlying stock. So say you buy 100 shares of a stock, covered calls can allow you to lower the cost basis of the long position via selling call options against your position. So let's take a look at my trading platform and set up a real-life trade in AT&T.
So for this trade in AT&T, you're going to want to make sure we have the February 17th expiration date selected, and you're going to want to make your spread type single here in this box if you're using Thinkorswim. We've got our strike prices down here in the middle, and we're going to be looking at the 19.5 strike here. And to recap this trade here, we are just looking to sell one February 17th expiring 19.5 strike call.
For this trade, a February 17th expiring 1950 call option can currently be sold for around 45 cents. This would generate $45 in premium per contract and increase the annualized yield of the stock by 35%. AT&T currently pays around $1.10 in annual dividends, so generating another 45 cents from a covered call in less than 1 month is quite attractive. 45 cents in premium received also gives a small buffer on the downside of roughly 2.3%. That means that AT&T could trade 2.3% lower between now and February 17th, and the covered call trade would still break even. The total capital at risk in the trade would be $1,885, and if AT&T went to zero, that's how much the trade would lose. But as reasonable and careful traders, we would be sure to close the trade long before the stock ever dropped to zero. If shares close above 1950 on the expiration date, the underlying stock will be called away at that strike price, leaving you with a total profit of the $45 premium received, plus any gains on the stock from the price at which you purchased it initially. As always, remember that if you're new to options, make sure you practice with a virtual account before risking any real money. And remember that options are complex and investors can lose 100% or more of their investment. Be sure to join us for our regular options content here where we discuss new trade ideas every day.
Hey everyone, thanks so much for watching Investors Business Daily on YouTube. If you want to watch more videos, make sure you hit that subscribe button so you don't miss a thing.